Hello there, my friends. Chris Marcus here with you on Thursday, May 11th. And today we have a short video about whether it's safe to invest in the stock market at this point. And if you might be aware, stock market is in record territory. Internet connection not playing nicely, but it's somewhere absurd around 20,000 above, which when you think about what happened following the housing crisis, where it got as low as 6,500 and has essentially since tripled since then. It leaves people in a very challenging situation, which might sound familiar, similar with the housing crisis or a couple of years before that, the dot-com crisis. You see prices keep going up. Everybody's excited. People are either making fortunes flipping houses or internet stocks. And what's tricky is that, again, this is one of the symptoms of printed money. It's hard to tell when the party stops. So, for example, back in 2011, when I started really researching the silver market and finding many of the things we talk about on this channel, I thought we were probably at the top then. It stunned me that the effect of how much the printed money can actually continue to push things up and distort what would otherwise perhaps normally be a free market pricing system, which is not really what we have these days. And sometimes it's unfortunate when I hear people saying how capitalism failed, which maybe be a better argument if we actually had capitalism. When you're bailing out banks and printing money, that's not capitalism. In either case, we'll save that argument for another day, although if you'd like to hear more of my thoughts about that, write in a question below and we'll take it from there. But the point being, things get skewed and you can extrapolate what by nature has to happen. It's just not always so easy to tell when. So obviously, if I took my money out of the stock market in 2011, I've missed a big rally. Again, so that part wasn't perhaps as much fun while watching silver have a rough time over the past couple of years, but really the trade-off and what might be helpful as you're thinking about this is remembering back to the housing crisis. I mean, again, both of them would work, but we'll stick with the housing crisis as the example. Sure, if you pulled your money out in 2005, you would have missed a couple more years of incremental gains. Yet, that's what, in my opinion, is helpful to balance, is that when you see a situation like this, if you don't have your money in the stock market right now, sure, it could go higher. The Fed could come out and say they're going to double the money supply tomorrow, which it's incredible that when you think about it is not really all that unrealistic. So you can make the stock market or any market any number you want if you print enough money, yet in real terms of the things you can buy and whether things just get inflated to a high degree or if the stock market actually does come down in price, at some point you're facing something that seems, at least again, just in my opinion, again, no investment advice, but just things to think about, seemingly at some point has to break. And from everything I've seen, when it breaks, it will be the most spectacular crash that I've ever read or studied in history. So to me, the trade-off, which is not as much fun when you're doing the smart thing and watching, or again, I'll say what I thought was the smart thing, and watching all these other asset classes get pumped up. Sure, it's not fun to watch, but especially going back to the mortgages. And if you've seen the movie The Big Short, a great example of this, of how that's the challenge of timing a bubble. Or trading a bubble is the timing. Some of these things just happen when they do, and for all the effort that we can put into trying being clever and figuring these things out, I mean, I've been trying to figure out when silver would have its upward ascent, which I still believe strongly is coming, probably a lot sooner than later, in my own opinion, based on what I'm seeing. But that's a challenge, and I don't know, maybe it's next year, so I could read everything I want and study it all day, but, it's going to happen when it happens. What we can do is be prepared for that. And I think that when you see some of these things that are just by nature, it's hard to see a scenario where at some point they don't break. Yes, you miss the risk of being in the mania, but I would argue that, and I remember one of the Casey, or it might have been Casey Research or Agora Financial, and they had basically, if you had just bought gold leading up to the 80s when the money printing, you had guns and butter and money printing was ramping. If you had bought gold leading up to that, and then saw when Paul Volcker raised, I think I'm getting it right now, took interest rates up to, I think it would, and the end of the short-term interest rate got up to 18% back then. So if you'd sold the gold then, invested in dollars, and then when the money printing started getting out of control again with Greenspan, had bought gold again, you would have had some stunning multiple that far outpaced just investing in the stock market. So you don't have to get the exact top and bottom. And when I hear people saying, well, I'm thinking about buying silver, but I think it might be 50 cents lower a week from now, it's important to keep the skew in mind, where if you're in the camp that you think silver might reach or eclipse its previous highs of $49 and $50, then is it worth trying to get that last bit, which if you can do it, great, and please please bestow some of these answers on me. But the point being, it's not easy to get the exact tops and bottoms, but these are the factors that you balance, and maybe you have reason to think that you think the stock market's going to go a lot higher before they have problems, then by all means, then I think following your intuition is always a good basis. But also being aware of the risks, thinking about, okay, well, I think this might happen, but how likely is it to happen? How do I want to trade that so maybe I'm not putting too much at risk, and hopefully the investments are something that can serve us rather than leaving us up worrying at night. So with that said, I guess the conclusion is I don't have any money invested in the stock market. Again, the two outcomes I see are either some sort of big move down, unless the Fed just sends us straight into hyperinflation, in which case the price would move up, but maybe you have 100,000 Dow and a slice of pizza costs $5,000. So in real terms, the stock market, what the value of your shares could buy would be coming down. And again, just from my perspective, I've yet to find a way where that doesn't happen at some point. So anyway, hope this was helpful. Please leave your comments below. I love reading them. I've been getting to answer most of them, and it's great to hear your feedback. And I know it's a challenging time to be an investor. It's a challenging time in many ways, especially for the people who are seeing what government and banks and a lot of these elements of the system have always been. And anyway, I find the more that we talk about it and discuss and learn from each other, I think somewhere in there, all this thinking and preparation, whether we have silver or not, but if you're seeing what's going on and reaching out to others and finding ways to team up with people and just combine your efforts, I think you're on the right track. So I'll be here sharing my views, and hopefully that's helpful. Again, hit the like button, share it on Facebook, and spread the word. And that said, I do hope you're having a great week, and we'll look forward to seeing you again soon. Thanks.